Hello everyone, and welcome to our Managing Wealth in 2020 workshop. Get this slide going. Okay. We believe an educated client is our best client. Today I would like to discuss some strategies that you could be doing now to help your overall financial situation in 2022 and beyond. Before we begin, it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Today's presentation will be primarily focused on investment planning and equity markets, and then we will share with you some proactive tax planning strategies. 2021 was a healthy and impressive year for equity markets. As this chart shows, in 2021, equity markets made very healthy advances. Since the quick but sharp fall of equity markets in early 2020, post-pandemic equity markets have been primarily robust. Despite many potentially detrimental events, the equity market showed resilience and prevailed, rewarding investors with notable gains. 2021 saw many new records broken. The S&P 500 had 70 record closes, and the Dow also saw some significant gains with 45 record closes. Stock valuations soared, and many analysts credited ultra-low interest rates and a healthy economic recovery for this surge. 2022 is already off to an eventful start. Volatility is very prevalent and looks to be here for a while. Inflation is surging, and several interest rate hikes are expected this year. Russia invaded the Ukraine, amplifying the global unrest that has been developing recently. While COVID is still a concern, it seems that it may be taking a back burner to recent New World events. As you look at this 40-plus year chart of the Dow, you can easily see that stocks have increased over the long term, notwithstanding market pullbacks and dips. The sharp decline of 2020 looks a lot less threatening as you look at long-term results. That's why having a solid investment strategy is an integral part of a well-devised long-term financial plan. Staying disciplined, not getting emotional, and following your strategy during times of volatility can be crucial, and it's important. Equity market downturns are part of the investment experience. They're uncomfortable, but not unfamiliar. Since 1949, over a 70-plus year period, on average, the S&P 500 has experienced a pullback of 5% about 3 times a year. A correction or downturn of 10% or more happens about once every year, and a bear market once every 6 years. Recently, statistics showed that at the end of 2021, inflation was at a 40-year high. Higher inflation means the cost of goods and services are going up, and therefore it requires many investors to look for good returns. Unfortunately, the cost of safety today is near zero. Most investors cannot live with these low returns of today's money markets, which in early March 2022 were less than 0.1%, and a 12-month CD, which were also way below 1%. By now, you may have heard that interest rates are set to rise in 2022. The Fed funds rate as of January 2022 was close to 0% and set to rise, which is not good for bonds currently. Once again, interest rates are low. With the Fed expecting to make multiple interest rate hikes over the next few years, we feel it is best for investors to do the following: review all income-producing investments, lock in mortgage rates, or consider refinancing to get a better rate if you haven't already done so. Maintain liquidity for all near-term needs. Reevaluate and confirm cash flow needs. Sometime this year, if needed, we can and will conduct a full review of your financial situation. During this review, we can look at risk management and how well diversified your plan is. We will also revisit your time horizons to make sure all your holdings are still compatible with your goals. Our hearts go out to all those affected by the Ukraine-Russia crisis. As of now, nobody knows how long it will last or how bad it will get. From a financial standpoint, this adds to the uncertainty of the near future, and economic markets do not like uncertainty. So, what are investors doing? Typically, the most successful investors think and act for the long term. Short-term movements in equity markets have always been near impossible to predict, but you can prepare. Remember, equities go up and they go down. They are long-term holdings and should always be viewed that way. One of our goals is to help our clients make smarter financial decisions, which could lead to better outcomes. Again, volatility is here. When equity markets retreat, caution and vigilance are critical. Please remember, volatility is part of the investment experience. Market pullbacks and downturns are not uncommon. Having a long-term strategy and staying away from emotional investing decisions can help you ride the pullback waves and stay on track towards your financial goals. As a reminder, focus on your time in the market, not timing the market. For example, selling equities during a downturn may help you retain your gains, but if you're still on the sidelines during an upswing, it could prove disadvantageous to the overall performance of your portfolio. If you have questions or concerns, now is a good time to revisit your financial strategies with us, including your time horizon and risk tolerance. Also, please remember that the returns we have enjoyed the last few years were well above the average and typical median of the past 20 years. There are many variables that could directly affect equity markets at any moment. Many economists are still optimistic that we could still be looking at favorable returns, just in more moderation. We remind you to always focus on your own personal goals and objectives. And as always, we are here for you. Please call us with any concerns or questions you may have. Now let's talk about proactive tax planning. We feel it is important to remember that proactive tax planning should always be a key focus when reviewing your financial situation. We believe that a proactive approach to looking at your tax situation could lead to better results than a reactive approach. Tax laws seem to always be changing. Recent legislation like the CARES Act and Secure Act made significant changes that could affect your 2022 taxes. One of our goals is to point out as many tax-saving opportunities and strategies as possible with clients. We will review some of the broad tax issues and some potential tax reduction ideas. Please remember that not all ideas may be appropriate for your personal situation. This is for informational purposes only, and we always recommend you always address any tax strategy with your tax professional. Let's look at some helpful proactive tax planning strategies for 2022. So let's quickly review some key 2022 tax information. The IRS has released 2022 tax brackets. There are still 7 federal income tax brackets which have been slightly adjusted from 2021. Long-term capital gains are still currently scheduled at favorable rates for 2022. Retirement planning for those who can is always helpful. In fact, it's never too early in the year to start contributing to your retirement plan. Here are the current 2022 retirement contribution plan limits. If you have any questions about your retirement plan, please give us a call. You might want to examine taking advantage of annual exclusion gifts. For 2022, the maximum amount of gift tax exemption is $16,000 per person, up from the previous $15,000. For example, you can give up to that amount to a family member without having to pay a gift tax. Some ideas for using this annual gifting can include contributing to a working child or grandchild's IRA, or gifting to a 529 plan, which is a tax-sheltered plan for college expenses. Here are some proactive tax planning strategies because, as we said earlier, we believe that taking a proactive approach is better than a reactive approach, especially regarding income tax strategies. Your objective should be to minimize your taxes whenever possible. It also changed some very important retirement withdrawal tax rules. This past February, the IRS and Department of Treasury released a 275-page document with proposed regulation changes and implementation details to the Secure Act, which stands for Setting Every Community Up for Retirement Enhancement. That was originally enacted in December of 2019. This act was designed to increase access to retirement plans and encourage retirement savings for many Americans. One of our goals as your financial professional is to keep you aware of any updates to fiduciary or tax law that we feel may affect your unique situation. The Secure Act, among many things, included a 10-year rule that replaced the stretch IRA for most IRA investors. Under the old rule, most non-spousal beneficiaries were able to use the stretch IRA, which meant they could take distributions over their lifetime. Today, unless you are the surviving spouse of the original owner, a minor child, a disabled or chronically ill individual, or are less than 10 years younger than the decedent, you're more than likely required to take out all your inherited IRA money over a 10-year period. This 10-year rule, especially on everything not in a Roth IRA, requires us to take a more proactive approach to potentially minimize your tax bills. The Secure Act also changed the required minimum distribution age to 72. Previously, the required minimum distribution age was 70 and a half. Under the Secure Act, distributions are required to begin by April 1st of the year after you reach 72. A critical area to review in tax planning for your retirement accounts is what we refer to as overall family tax bracket management. If you have retirement assets that are not in a Roth IRA, when and who takes distributions can make a huge financial difference from a tax standpoint. Simply put, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than you in yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your bracket. Convert these accounts to Roth IRAs and leave them an account that still must be taken out in 10 years after your death, but can grow tax-free for up to those 10 years. A key step that we like to start with to help clients look at tax minimizing is to compare your marginal tax rate with your beneficiaries' marginal tax rates each year. This is something we try to think about for clients, especially those with large retirement accounts. Especially now with the Secure Act 10-year rule, for some people, exploring a Roth IRA conversion should be helpful. Some benefits from Roth IRA conversions include they could lower your overall taxable income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no RMDs at age 72. Roth IRAs allow tax-free withdrawals for beneficiaries. Partial or full Roth IRA conversions are not for everyone. Whether you convert part or all of your traditional IRA to a Roth IRA depends on your situation. Before doing so, it is best to prepare a tax projection and calculate the appropriate amount to convert. Like with many financial decisions, there are several pros and cons to making this change. Please call us or talk with your tax advisor to see if this makes sense for you. For those of us who are close to the standard deduction level, a strategy to consider is bunching your charitable donations into a donor-advised fund, or DAF. As this example shows, someone who is slightly over the standard deduction each year can bunch 3 years of charitable contributions into a donor-advised fund in year 1. This could bring that taxpayer a much larger overall tax savings over, in this example, 3 years. Then, as the other side of the screen shows, from your donor-advised fund, you can still give your charity money each year. Now is the time to explore if it is helpful for your tax situation to deposit cash, appreciated securities, or other assets into a donor-advised fund and then distribute the money to charities over time. For more information on this strategy, give us a call. Qualified charitable distributions are still a strategy for retirement savers in 2022. This provision allows retirement savers to directly distribute up to $100,000 to eligible charities straight from their retirement accounts after age 70 and a half and not pay tax on this distribution. One idea that experts suggest, if you are charitably inclined, is to consider using part or all your required minimum distribution, or RMD, if you're over age 72, for a qualified charitable distribution, or QCD. Like many of the other strategies we're discussing today, this is one you should see us about if you're interested in evaluating your situation. This was a lot to review and think about today. So what you can expect from us, you can expect regular communication, more frequent discussions, and you can expect that we are frequently reviewing economic, tax, estate, and investment issues for our clients. We hope you've been receiving our mailings, including the most recent tax report. If you haven't, or if you'd like a copy sent to someone you think may benefit from the information in it, please give us a call so we can make sure you are on our mailing list. One of our goals is to continue to help others. Some of our best clients were referred to us by existing clients. So please feel comfortable letting us know the names of anyone who you feel could benefit from our services or information. Again, one of our primary goals is to keep clients informed, and we appreciate you attending our session. Please call us if you have any questions. Thanks again for your time today. Remember, your health and well-being is our highest priority. We appreciate the opportunity to assist you with your financial needs.